Hello everyone. In this video, I'm going to talk about Deriv synthetic indices. A lot of you might have heard of synthetic indices but don't know what they actually are. So in this video, I'm going to talk about what synthetic indices are, how they work, their advantages over forex pairs and currency pairs, and why a lot of traders like synthetic indices. So let's take them one after the other. First of all, a lot of people think when we mention Deriv broker, it is only about synthetic indices. No, when it comes to trading here, you will see they have Forex, derived indices, stocks. They have all kind of trading pairs. Just that they have the derived indices, and that's what makes them stand out. So when you hear derived indices, it's only Deriv that comes into mind. That's why a lot of people think they are only about synthetic indices. It's always advisable to go for Deriv broker because they allow you to trade the synthetic indices and the forex pairs and all other pairs at once in one account, unlike other brokers that have only forex, only commodities, only cryptocurrencies. This time around, Deriv has combined everything. If you want to sign up on Deriv, the link is in the description of this video. You can follow and sign up. Let's move on. Let's talk about what synthetic indices are. Currently, we are on the Deriv trading view. This trading view is a bit different from the normal trading view that we use to analyze forex and currency pairs. This trading view is only about Deriv synthetic indices. I'll drop the link to this trading view in the description of this video. Let me go on and explain what Deriv synthetic indices are. First of all, synthetic indices are the Deriv synthetic indices are unique financial instruments created by Deriv. They are owned by only Deriv. Unlike currencies or stocks, these indices, they don't depend on any real world economy. They are simulated markets that mimic real market movements. In simple terms, they are like real markets with volatility, trends, pullbacks, everything. But they are not affected by global news, politics, or economic events. For example, when you are trading Euro USD, which is a currency pair, the pair is about Europe and US. So news from Europe or US can affect price movements. But with the synthetic indices, you trade in a controlled environment, pure market movements, no external influence. The volatility is always constant. The speed at which it moves right now, it will forever move like that. Also, there's no manual intervention and the market is available 24/7. Even on weekends, the market is available for you to trade because it is not affected by any real world event. Had it been that it was affected by real world events, when banks are on holidays or when we are on weekends, when banks and institutions do not operate, this market should have been closed. But because they are not affected by any real world events, it is always available for you to trade. Now, there are categories of Deriv synthetic indices, which I'm now going to explain them to you. We have the volatility indices, the boom and crash, the step indices, the range break indices. Each of these categories have their own unique behavior. This is one of the volatility indices that you see on my screen right now. This is volatility 75 index, and there are a whole lot of volatility indices. We have volatility 10, 15, 25, 30, 50, 70, 75. All these have their own unique volatility. When you take the volatility 10S, the volatility is low, it is less volatile. And when you take the volatility 100, the 75-25S, they are highly volatile. In future videos, I will talk about their different volatilities and the best of them for you to trade. When you take boom and crash, they are known for their sudden spikes. This is a crash index on the 1 minute time frame. You can see that by default, it is going up all the time, it is buying, and there will be sudden spikes along the way. So this is a unique behavior of crash. And when you take boom, it also buys it sells by default. They sell by default and there will be sudden spikes going up. So this is a unique behavior of boom and crash. Boom sells by default and spikes come along the way, and crash also buys by default and spikes come along the way. Also, there are jump indices. Jump 10, 25, 50, 75, 100. When you look at the jump chart, you can see that there are sudden spikes. Some goes up, some comes down. Unlike the boom and crash, when you take crash, all the spikes, they move downwards, or they are headed downwards, or they spike downwards. When you take boom, all the spikes, they are headed upwards, or they spike upwards. But for jump, some goes up, some comes down. At any point in time, when the jump is occurring, it can go up, it can come down. They also have step indices. So you see step index 100, 200, 300, 400, 500. For the step indices, they move in fixed steps. So look at the price movement on the right side over here. You can see that the price moves with a difference of 0.1, 0.1, 0.1, 0.1. So that is it about step indices. And they also have range break. So you can see range break 100, range break 200. So this is how the range break behaves. A lot of people love it so much because of its unique behavior. Breakout traders like to trade the range break a lot. This is how it behaves. Personally, I don't trade it because it looks very weird to me, but a lot of people love it. So these are the different categories of the Deriv synthetic indices. Each index has its own personality, its own behavior. So you as a trader, you need to stick to what works for you. Personally, I don't trade range break, and those that I trade, they work for me very well. So there's no need for me to be rushing and be looking for other pairs. I just stick to what works for me, and that is it. With that being said, I would like to talk about some of the advantages that you only get on synthetic indices that you will not find on the Forex and stock indices or cryptocurrencies. When you take the synthetic indices, they are available for you 24/7. On weekends, even on holidays, they are available for you to trade. And the volatility is constant. Unlike currency pairs, holidays you will not be able to trade, weekends you will not be able to trade. Low capital requirements. Synthetic indices does not require too much funds before you can trade well. No, you can start with as small, as little as you can afford. Any amount, no amount is too small when you are trading synthetic indices. But remember that because they are available 24/7 every single time and the volatility is constant, if you don't take your risk management and your trading psychology serious, you might be tempted to trade every single time. So this is a clear breakdown of the synthetic indices, what they are, how they work, and why they are unique in the Forex market. In my future videos, we will dive in and talk about the best of the synthetic indices, those that are advisable to trade and those that you should not trade with. Do not forget to subscribe to my YouTube channel and like my videos. Thank you. See you guys later.